So I thought today I'm going to hold off making a video. I'll see how the markets open up and what happens there. We had a bit of a eye of the storm. We got to the eye of the storm yesterday with the stock market. It seemed a bit peaceful out there, a little bit too good to be true. And then today, boom, it was like another punch in the face. And there was a lot of red out there. We're going to be covering a lot of that red. There was a lot of red in the US markets. There was a lot of red in the UK markets. So I thought I'd split the video into two parts, covering the UK market first, then covering the US market on the second part of the video. So starting with the UK market, painful once again. And you could say that the UK market has been the reason for dragging down really a lot of the other markets, and even the US market you could say is being dragged down slightly because of the UK market at the moment. The FTSE 100, one of the more reliable indexes, doesn't really do too much, but even this is getting dragged down at the moment. And the FTSE 250, which I think is a bit of a more fair reflection on the UK market, down 12% in 1 month. And if you go in the last 5 days, down 8% in the last 5 days. And wherever you look, there's a lot of negativity out there in the UK market. Obviously, a lot of it is to do with the mini budget that came out. Following the mini budget, it didn't help that a lot of the mortgage deals were pulled. As soon as one kind of mortgage lender starts panicking, it just feeds into the whole mortgage industry, and we're seeing a lot of mortgages getting pulled at the moment, and this is obviously not benefiting the housing market at the moment. The pound is collapsing hugely at the moment, and that has deteriorated so fast. I think it's at the lowest level for so many years. I can't remember exactly off the top of my head, but it's the lowest for a long time, and that's absolutely collapsed through the floor. And obviously one of the big push downs recently was the mini budget, and the IMF has actually come out and warned the UK over the mini budget tax plan as well. And yeah, that's obviously added on to a lot of pressure when you've got a lot of people out here that are now questioning this budget. And that's all fed into the stocks. And the thing is, this is fed into now even this, what you would call historically the safe UK stocks, something like Legal & General. I actually opened up the my app or broker this morning, and I just had a quick flip through to see what's happening, just assess what are the stocks I want to be looking at buying at. And I was really surprised to see how much something like, you know, the Legal & General has really deteriorated over the concerns over at the moment. Obviously something that offers, you know, financial products at the moment obviously has been spooked by a few of the issues that we just mentioned there. And yeah, obviously this has deteriorated massively, and this was one of the stocks that had been holding up okay, and then boom, within the last month it's down 16%. And most of that coming in this last 5 days, funny enough. Last 5 days down 16%, and is now down at a P ratio of 6, and also a dividend yield of 11% at the moment. Barratt Developments, house builder that I own, but you could have put any house builder on this list, now trading at 6 times earnings, paying 11% dividend yield at the moment. Now obviously there's a lot of uncertainty at the moment with the housing market. You've seen the interest rate skyrocketing. Is that going to potentially put people off selling the houses? A house price is going to crash, and this has led into what was once again another safe stock absolutely collapsing. 5 days down 21%. 5 days lost 21% of its value, down 25% in the last month, and year to date down 57%. This year Barratt Developments has lost half of its valuation. That shows you how bad things are currently at the moment, and just look at that massive drop off down there right now. Greggs, I mean, I have not bought Greggs, and actually just going back to Barratt Developments, I just wanted to point this one out. I mean, just look at this. Barratt Developments is now below that big peak fear day in the CV situation. That's how low it is at the moment. Greggs is getting to buying range. I have not touched Greggs for so long. As many of you guys know, one of the stocks I prioritised during the CV dip was Greggs, and I remember buying it in this period of time, and it started going up, and I was like, oh, fair enough, you know, we're up 20-30% through the CV dip, through that, you know, March, June time. And then Greggs was a stock that just carried on through like June time to like November time, just kept going down and down and down. And then from that June period, the stock was down like 40%. I was like, whoa, you know, why does this keep going down? And I kept buying, and it's one of the stocks that I made many videos on about buying this opportunity. And then wouldn't you know, boom, we had a really good rally. You know, the stock went absolutely crazy. I sold off half my position, and I thought, you know what, Greggs is just a solid business that will pay me a good dividend. I think it's got a very safe future in the UK. Everyone still wants the sausage rolls. But now even then, from that high there, the stock's lost half its value. And I'm looking at something like Greggs at 14 times earnings and a 3% dividend yield. And I thought I'd never see Greggs like falling off this much again. And now it is doing. I'm looking at Greggs and I've not bought this for, over 2 years now. And I'm thinking, maybe it's time to start going back into this one. I mean, I personally wouldn't. I mean, if this started touching single digit on the earnings PE ratio, and that would hike the dividend up to over 4%, then I mean, I might have to consider it. Which I never thought would see the day of that happening again. I mean, Games Workshop. This is not a stock that I own, but I just track this one because I know it's really popular on the UK scene. And even this is down at 15 times earnings, 4% dividend yield. And year to date, this is another one down, nearly 40%. And next come out with earnings today. And I think this is a bit of a glitch on the chart here, from here. But from that point here, Greggs was down 12%, trading at 9 times earnings, 2% growth. And I looked at Greggs' earnings and I thought they were absolutely fantastic. I thought they were really good numbers. Obviously, the forecasts were not fantastic and they did trim the forecast. And the reason why they trimmed the forecast is basically they came out and said, we're seeing some weakness, but we don't know how bad this weakness is going to be, or if it's going to continue to worse, or we've actually seen a little bit of improvement going on, and potentially if that improvement continues, then we're going to be okay. So they just went, it's easy for us just to cut the outlook here, and the market didn't like it because they went, it's just easy for us to cut it here. And to be fair, like the forecasts that were given were actually like pretty strong, because when you consider like the forecast, consider to like so many other companies in this sort of similar industry, like the forecast was still actually quite strong, and obviously they got punished for it. And same again, a stock that's down nearly 40% year to date. And that was just the pain in the UK side of it. By the time we get to the US side of it, the Dow down another 1.5%, the S&P down 2.1%, the Nasdaq down 2.8%. I mean, these drops are massive. I saw something a while ago. I can't remember where it was. I think it might have been on the Discord, and someone sent it on the Discord. And it was like the amount of, I think it was over 1% drops at the moment in the market is near a record high this year. Like the amount of aggressive drops that we had is near a record high to have that many drops. And it's just been insane, the selling off. I mean, seeing the Nasdaq down nearly another 3% today is just absolutely insane. And, we're back to a market where there's extreme fear. And, look at the Nasdaq. I mean, year to date down 32%. This is unbelievable territory to be in. This is the crash. This is the crash that you talk about. Will we ever have a crash? We're in it. This is it. This is history where we are talking about the big one. The big one that everyone talks about, when we're going to have the next big one. It's here. This is history. There'll be times where we've had over the last 10, 12 years where people refer to, are we going to have the '08 crash again? So many investors never went through that '08 crash. There's so many new investors on the scene. You've never been through a big market crash. This is it. This is history. This is the big one. This is the crash that will be on the terms of the '08 crash. Even though I would say the situation is nowhere near the level of the '08 crash, is the pain is very similar. It's been a painful over a year really now at the moment, especially even longer if you're in a small or mid caps. The pain's been such a long time. And the big difference today is Apple joined in. Apple was down basically 5% today, and Apple's been the untouchable one. Apple's been basically one that's been holding up okay, and then it had people took a massive rally into that June dip where we saw a bit of a bottom, but then we're starting to sell off again. And I see Apple down 5% today basically is a massive statement, because Apple's a stock that's just held up. And it's crazy. I generally think like it's amazing to see Apple still hold up this well at 23 times earnings when there's so many other stocks falling off a cliff. But I think the key thing here is that Apple was downgraded by Bank of America, and that when you're in that negative market that we're in, all it takes is that little bit of negative news and boom, it's a massive hit. It's a big massive amounts of fear, and Apple kind of got that today when it was really immune to it. And this downgrade here from Bank of America really was the root cause of it dropping down 5% today. And the crazy thing is, a lot of this is done of analysts of what they think the price is going to be in 12 months. and they moved it down from 185 to 160. And they basically put that down to weaker demand. Now the crazy thing is when you do look at Apple and their share price for the next 12 months is $160, so it's at $142. So there is basically Bank of America, you know, the news was taken a really negative way. But when you look at it, it was actually a point of view of like, even considering that, they still think that in 12 months time Apple's share price is still going to be higher, which I think speaks a lot really, that when you still think of it, they're saying, oh yeah, it's going to be higher in 12 months time, just not as much as what we thought, but that was, you know, massively took in a negative way. And it just adds on to the pain that we've had this year. You know, Amazon down 32%, Google, you know, probably one of the safest stocks out there, you know, 18 times earnings, massive profit monster, probably the best balance sheet on the stock market, down 32% at the moment. PayPal, you know, this one's down 54% year to date. You know, one of the big, you know, fintech companies being absolutely killed. Adobe, I mean, I started saying, well, if Adobe gets to 280, I might take a look at it. I think people probably come in and buy that dip before it gets to that point. And then it touches $178 today, and it's down 50%. And it's like, you know, one of the kings of the SaaS platforms, absolutely getting slaughtered once again. You know, to see Adobe down 50% is just absolutely unheard of. I mean, Meta, you know, Meta is down 59% year to date. And this is a company now that is, and there's a lot out here, this is a company now that is trading back at the levels. I'm going to even have to go further than 5 years out. I'm going to have to go further than that. I'm going to have to go on the max chart here. And the last time Meta was at this sort of valuation was in April 2017. Over 5 years ago, Meta was at these sort of levels. 5 years ago. That is how low Meta is. 11 times earnings. And just to put that into context, I mean, just look at this progress. I mean, if we look at the 2017 financials here to where we're at now, the company's just made so much amounts of progress, and it's back at 2017 levels, and it is painful to see. As an investor, it is painful to see these days, and it's painful to go through them. Unfortunately, it is going to happen at some points, and we are going through that at the moment. And you can see the valuations that companies are getting absolutely pushed down to at the moment. And you know, just look at Meta and how much that is absolutely getting wiped off at the moment. And it's not the only one as well. And at the moment, it's painful. It's painful to be an investor. It's one of those days where it's one of those time frames where, personally for me, I just, you know, if I didn't have to make these YouTube videos, and if I wasn't really like on the Discord and stuff, it's one of those days where I would just lock the portfolio away. I wouldn't look at the markets, and I will think, will I benefit from buying in this situation in 5 years' time? Will I benefit buying Meta at the levels that it was at in 2017 in 5 years' time? Will I get the rewards from that? And that's what I would be thinking of, and trying to buy opportunities that I really like, opportunities that I think are massively sold off. And there's some pain going on in the world at the moment, but is that pain justified? Is the pain justified to be at the levels that we're at the moment? And I would just be trying to capitalize on opportunities where I think I would do okay buying those opportunities and holding them for the long term. And that's what I try and really focus on in these time frames. And I think it's one of those golden opportunities, you know. I think it's one of those opportunities where you look back at stocks that went to crazy valuations in 08, and we get into them sort of levels now in 2022, and you know, you look back at them time frames and go, oh, you know, look at that stock, it went to that level, can you believe it? And I'm trying to look for those opportunities right now, because without doubt, you know, this situation that we're going through in the world right now is painful. But is this painful situation going to continue forever? Is this painful situation going to be in a time frame where inflation is still going to be an issue in 5 years' time, or even 4 years' time, or even 3 years' time, or maybe even 2 years' time? May I dare say even a year's time? You know, will it be an issue? Will the interest rates be an issue in that time frame? So I'm just trying to look at that point of view and capitalize on the opportunities that I can do. And it is tough. It's tough. There's no way to put it. You know, people have given up on the market. Investors have quit on the market. It is a toll being an investor, and if you do check your account every day, you're like, oh, it's another red day, isn't it? You know, it's awful. It's an awful time frame. There's no other way to put it. But unfortunately, this is where it kind of comes to who is a good investor in the tough times. It really is the times that, you know, really make or break you as an investor, these sort of times, and capitalizing on them opportunities. So yeah, ugly day out there. Personally, for me, that's what I'm trying to do. I'm trying to stay focused. I'm trying to look for the opportunities. I'm trying to buy the opportunities that I think will do well for me in the next few years, and where I look back and go, oh, thank goodness I bought that in that 2022 crash. But it's ugly out there. But there's opportunities, and I'm trying to capitalize on them. So that's what I thought I'd talk about today, guys. Yeah, hope you enjoyed the videos anyway, guys. Hit the like button as always, and I'll see you on the next video.